So this is a webinar. You're not going to be able to speak to me directly. You can hear me, but you can type your questions into the Q&A box, or you can type whatever you have to ask in the. You can type things into the chat box as well. But yeah, because this is a webinar, you're not going to be able to. I can't hear you. We can't have a dialogue that way. The only way you can communicate with me is through the chat or the Q&A. All right, so let's get started. So welcome this evening. I'm glad you guys are able to join us. This is a financial management for young adults. And my name is Junaid Noor. Wanted to give you a brief introduction on why we do this webinar. First things first, I gotta do a little bit of housekeeping. So you see a Q&A box. You can ask your questions as we go, and I will try to answer them as we go. I also try to keep this interactive, so I will ask you some questions, and I will hope you can respond to me in the chat. So if you can hear me and everything is good, just give me a thumbs up in the chat. Anybody? All right. Now, so what you could do is you could hit that emoticons and do that. Got it? So you see that little emoticon button? You guys can hit that little button, and there's a bunch of little emoticons that you could use. All right, very good. Okay, very good. So let's go ahead and get started. First things first is disclaimer. This webinar is for education purposes only. I'm not your financial advisor or your legal advisor, so don't take it as such. So the reason we got this webinar started is because as my kids, I have two kids in college, and as they were getting older, I would talk to them about financial management. And, I would ask them questions about, what do you know about budgeting or saving or credit or things like that? And they would be like, oh, we don't know anything. And it turns out that, the schools don't do a very good job of teaching this information. It's really up to the parents. So I started teaching this information to my own children, and I'm hoping you guys will benefit from this as well. So like I said, let's get started. My name is Junaid Noor. I am the founder of Albany Park Capital. We are a investment company. We raise capital for development and real estate projects. I'm trained as a CPA. I'm also certified in financial planning and analysis. I have over 30 years of real estate business operations and finance experience. And I also host a real estate podcast called Cigars and Syndications. Okay, everybody with me? All right, so let's get started with this. If you don't find a way to make money while you sleep, you will work until you die. Does anybody know who said that? If you know, type it in the chat. Anybody?
And don't Google it. Don't cheat.
Yeah, don't cheat. Don't Google. Just type it in the chat if you know it. It was Warren Buffett. And so I start with this slide because I'm going to come back to this slide at the end. Hopefully, this is not going to be too long. I'm not going to take up a lot of your time. But like I said, if you have any questions, ask in the chat or ask in the question and answer, and I will answer your questions as we go. Okay, so I start with this slide because that's kind of the premise of the slide. I want to teach everybody on this webinar financial management, but I also want to teach you how to make money while you sleep. And I'm not selling anything. This is not going to be an infomercial. This is just information that I learned over the years, and I talk to my own kids. So let's start with the financial mindset in America. Americans spend 3.5 times more than they invest. We are a consumption-based economy, unlike Japan, which is a savings-based economy. And the reason I go through this information is because so you understand that you're not, the reason you everybody in America want to spend money is because we get bombarded with the marketing and the sales and the pitches, and they need our money in order to keep the economy going. And if you look at this portion right over here, 68% of America's goods and services of America's economy is based on the consumer spending money, the consumer consuming. Okay, now This is a chart that shows how consumption has been increasing in the economy as a result of in growing the economy since 2010. Now, something happened over here in 2020. Can anybody tell me what happened in 2020? Why we had this dip? Anybody know? Just type it up. Type it up in the chat if you know. Okay. All right. This is COVID. COVID happened and we had this big drop over here. And as soon as, and of course, COVID was, you know, you couldn't buy anything, you couldn't do anything, you couldn't go anywhere. So people stopped spending. As soon as COVID was over and everything opened up, people started spending again. And not only did they start spending, they started spending more than they did pre-COVID. As you can see, this thing is going up. Okay. Now, what happens when people consume so much money? So much of their money is that they don't have savings. And so when there was a survey done that asked Americans, are you ready for $1,000 emergency? Only 39% of them actually had the savings to be able to do that. Everybody else borrowed or they charged it on their credit cards. So this just gives you an idea of what the economy that you are surrounded by, you know, everybody around you is spending. Very good, Imran, COVID. The emergency savings that people have increase with income, and that makes sense, right? If you make $50,000 a year, you're not as well prepared, you're not saving as much, and you're not as well prepared just because you're paying basic bills, and you're not as prepared for an emergency as somebody who's making $75,000 a year. So now that you understand what you're faced with and what you're surrounded by, how do we get away from that? That's the idea, right? How do we get away from this consumption mindset? So the first thing you need to understand is the difference between income and net worth. What is the difference between income and net worth? So income is what you make. Net worth is what you keep. So everybody with me so far? Income is the money that you bring in, whether you have a job or your parents are giving you money. That is money that's coming into you. That is income. Net worth is how much of it is it that you're actually keeping. Net worth, so how's net worth calculated? Basically what you own. That could be cash, that could be any property, that could be stocks or fractions of stocks, that could be crypto, minus what you owe. So it's a very simple equation. How much do I have? How much debt do I owe? The difference is my net worth. Okay. So what is a better indicator of wealth? Is it income or is it net worth? So anybody know who this is? Type it up in the message panel if you know who this is. Anybody know? Bulls fans? Come on, my Chicago guys. So this is Dennis Rodman. In the 1996-97 season, Dennis Rodman made $16 million in today's money. Now, he played for maybe 10 years, and he made anywhere between $3 million and $18 million a year. How much do you think he is worth today? Type up what you think that number is today in the chat box, please. What do you think he's worth? He made $16 million in 1 year. 250,000, Amina Rahman, 1 million. Wow, Muzammil. He is worth $500,000 today. So why is that? What happened here? Well, this is the basic premise of this whole webinar, right? It's not how much money you make, it's how much you keep. So if you make $16 million and you spend 17 million, that year you have nothing left. Or if you make 16 million and you spend 15.5 million, then you have $500,000 left. So at the end of the day, it comes down to not how much you make, but how much you keep. Most Americans have little or no net worth. And if you look at this graph, it tells you that between age 35 to retirement age, which is about 64, 67 right now, these are the median and mean net worth of people within those age groups. Now, most of your money-making years are going to be between 35 and 65, right over here. Now, what's interesting here is that the median is very low. For example, for this one, 168,000, and the mean is 833,000. So you might ask, what is the difference here? Why is there such a big difference? Well, the median is the middle number. The mean is the average. So if you take all the net worth of all the people divided by the number of people, you'll get the mean. So why is the mean so much higher? Because the mean is skewed. 1%, the top 1% of America owns 31% of the wealth. The top 10% of America owns 68% of the wealth. That's why that mean gets skewed, because the wealth is distributed so unevenly in the United States. So education has an impact on how much your net worth is going to be. People who have college degrees usually have a higher mean net worth and also a higher median net worth than people who have not had their college degrees. So make sure you understand that, make sure you keep that in mind, that education makes a big difference. So next one I'm going to talk about is, what do you do with your money? Well, there are only two things you can do with your money. You can spend it or you can invest it. Now, I'm going to go through each one of these concepts in a little bit more detail so you can understand what the differences are and how to go about it. I mean, everybody knows how to spend money, right? But how to go about it and how to go about the investment portion. So if you're going to spend the money, make sure that you have a budget. That's the first thing. Make sure you are aware of your debt and make sure you are aware of your FICO score. Now, I don't know what all the ages are of the people over here on the webinar today, because we opened it up to high school, college, and post-college people who just graduated. But who knows what a FICO score is? Anybody know? Type it up in your chat box, please. What is this? What is this FICO? Anybody know? Okay, so the FICO is a score that if you have a social security number and you're over 18, you're going to have this score. And I'm going to tell you more about it in a little bit. Okay. So the first thing about having a budget, okay, understand what your gross pay is versus your take-home pay. So take-home pay is usually your pay after all your taxes are cut. And if you don't have a job right now, ask your parents the difference between the gross pay and take-home pay, and they'll probably frown, because the government takes taxes, and sometimes there are a lot of taxes, and nobody likes to pay taxes, but your take-home pay is where you start, because that's the money that's coming into your pocket, okay? The second thing you want to do with your budget is take 10% off the top and pay yourself. Now, if you understand the concept of paying yourself, understand it this way. You pay everybody else. When you go to Target or Macy's or Walmart, you pay them. You pay the people you buy food from. You pay Starbucks. Well, you're paying all that out of your pocket. So pay yourself first, 10% off the top, and that'll be your minimum savings. Now, remember, the top 1% of America, they put 60% or more of their savings, of their income in savings. So at least start with 10%. Then the next step is to allocate the rest of your money and then keep an emergency money, a cushion for emergencies. So this is the basics of how to put a budget together. The next thing you need to do is be aware of debt. Credit cards are very convenient, and for those of you who are younger, you don't know about credit cards yet, or you may have one from your parents and you don't really care about making the payments. But as soon as you turn 18, the credit card companies start giving you credit cards. And they'll start you with a small $500 limit, but they'll increase it very rapidly because they want you to spend. And the reason they keep increasing those credit limits is because people spend money that they don't have and they can't pay it, which is where the credit card companies all make a lot of money, right? 21% or higher interest rates, late fees. So look at this example. If you charge $1,000 and you make the minimum payment of $25, it'll take you 68 months to pay that $1,000 off. You will pay $707 extra in interest because you charged $1,000 and you spent it on something and you made monthly minimum payments, okay? Any questions so far? Everybody with me? Am I going too fast? Am I going too slow? You guys know all this stuff already? Give me a thumbs up if you're still with me. All right. Great. Very good. Okay. So FICO score. What is a FICO score? Like I said, if you have a social security number and you're over 18, you have a FICO score. There are three major reporting agencies that report your FICO. The scores range from 300 to 850. You need to maintain about a 700 in order to have a good FICO score, what's known as a good FICO score. Now, why is FICO important? FICO is the lifeblood for obtaining loans in this country. So as you get older, you want to buy a car and you need a loan, you want to get a mortgage, you want to start a business, anything you want to do where you need a loan, the creditor, the bank, or whoever you're obtaining the loan from is going to look at your FICO. And most Americans fall within 45% of Americans have good FICO scores, and then the rest of the people just kind of let it slack off. So what affects the FICO score? Well, if you pay your debt on time, you pay your credit cards, your mortgage, all your payments on time, your FICO score will increase. You need a minimum of 3 credit lines. So if you're 18 years old, you just turned 18, you got your first credit card, you need 3 credit lines in order to start establishing a good FICO score. You do need to use debt. So you need to use those credit cards. But the idea is charge the credit card, charge for only what you can afford, and pay it off before the end of the month before you get charged those fees and that interest. And don't have high debt balances. Those are the things that will increase your FICO scores. And remember, we need to keep our FICO scores above 700. So, and a lot of people on the webinar may not be thinking about this right now, but think of it this way. If you're a sophomore in college, in 3 years, you're going to be out into the workforce. If you're a freshman in college or you're a senior in high school, in the next 5 years, you're going to be out in the workforce and you're going to be making money that you're going to be able to spend and charge credit cards and buy things. So what decreases your FICO? Late payments. Anytime you have late payments, they'll start hitting your score. If you open up too many charge cards, too many credit cards. So, when you go to Kohl's or you go to Macy's or you go to some of these department stores and they say, hey, we're going to give you a 20% discount if you go ahead and open up a credit card. Well, if you open up too many of those credit cards, your FICO score starts going down. And then, of course, if you charge up your credit cards to the max and don't pay them down, that will also decrease your credit score. Okay. So now that we've talked about the mindset, the people that you're surrounded, the people that we are surrounded by in America, the consumption mindset. We talked about budgeting. We talked about FICO. We talked about how to save money. Now let's talk about what you do with that money when you save it, right? So let's talk about investing now. So what is investing? Investing is the process of allocating money to preserve capital and receive a return. Now, this is a dictionary definition, but let me just break it down for you and make it very easy. You put money into something, you want that money back, and you want a return. If you don't get your initial money back and you don't get a return or you don't get a return, then it's not investing, it's just a scam, okay? Whenever you think about investing, think about long-term. 3 to 5 years is a good hold period. If you go shorter than that, it can be short-term investments, but usually investments, when you think about investing, you want to put a long-term investment period on something. And think about compounding. And I'm going to get into what compounding is, but let me tell you real quickly, Fidelity Investments, a brokerage house, and they did an analysis of all their account holders. And across the board, they found one type of account that was consistently making money. And that was the account where nobody traded stock in that account or touched that stock for decades and decades and decades. Now, either the person died and the family didn't know that the account was there and it just kept growing, or the person opened up an account, purchased stock, and just forgot about it. And it was just growing. So they noticed that the accounts that made the most money are the ones where people buy things in the account, stocks in the account, investments within the account, and they just leave them alone. They don't touch them. So now we'll get into compounding. What is compounding? Compounding is basically when you take the returns from your earnings. So you invest in something, you get money back. You take $1,000, you put into Apple stock, you got $10 back at the end of the year. Now, you can spend that $10 or you can reinvest it, and now you have $1,010 worth of Apple stock at the end of the year. That's compounding, okay? So let me give you an example of how compounding works. If you were given $1 million or you were given a penny that doubles every day for 30 days, which one would you choose? Type it up in the text box. What would you like to have? $1 million up front or 1 penny that doubles every day for 30 days? I'll give you a few minutes. Penny that doubles. Okay. Anybody else? Okay. So the penny. Wow. Okay. Let's see why. Why? How long is it doubling? 30 days. Penny that doubles every day for 30 days. Okay. Let's see why. The calculation is as follows. 1 penny that doubles every day for 30 days gives you $5.3 million. But here's the catch. You have to leave it in there for the 30 days. If you pull it on the 27th day, you only get $671,000. That's how compounding works. It's all about time. The longer you can leave it in there, the more you'll compound and the more money it'll make. Isn't that fascinating? Just a 3-day difference, and you have a difference of millions of dollars. Okay. So let me get into a little bit about what types of investing there are. Now that I explained investing to you, I explained compounding to you. There are 2 distinct types of investing that you can get into. There's active investing, and active investing is basically, anybody who actually ever had a lemonade stand. I know when I was in college, I would go and buy T-shirts and sweatshirts from one of my dad's stores who would print these bulls and bears and cubs, and then I would take them to college and sell those. I would pick them up, I would buy them, I would sell them, I would go buy more. That's active investing. You are involved in actually trying to make money. In order to do active investing, though, you really need to change your mindset. It needs to go from consumption to investing. And it also requires discipline. So let me give you an example of how this would work. Let's say you want to buy this really nice PS5 console with all those accessories. Okay. If you're a guy, if you're into that, or if you want to buy these Louboutin pumps, both of those cost about $1,000. So what can you do instead of spending that $1,000 right out of the gate on these products? Well, and this is just an example. You don't have to go for this example, but just to try to make you understand how this works, right? So I went and found a lawnmower. That lawnmower costs $269. So here's the math. If I charge $20 per lawn, I mow 8 lawns per weekend. I do it for 8 weekends. I made $1,270. I paid the $269 off for the lawnmower, and I still have this extra $1,000 to purchase the shoes or the gaming console, and I still have the lawnmower to be able to mow more lawns. So does everybody follow me? It's a mindset that has to be changed. The mindset is, rather than spending money that you don't have or spending money out of your budget, try to create an income stream which will bring you extra money to be able to spend. Is that confusing? Is everybody with me? You guys okay? All right. Moving on. So how do you get through passive investing? What do you do in order to do some passive investing? Well, Stockpile, and again, I'm not endorsing Stockpile, Robinhood, any one of those companies. They let you buy, now everybody lets you buy fractions of shares, right? So you can spend, $50 a month, $20 a month, buying fractional shares. And Stockpile is one of those. My son, he's 15 years old. He uses Stockpile. He's been using it for about 4 or 5 years now. And, his first purchase was $200 that he got for holidays, $200, and then he put that into I think he put it into Apple stock, and Apple stock pays dividends, and he started making money. So passive investing is basically, you're not going and mowing lawns. You're putting the money with someone else, and then they're giving you that return. That's passive investing. So if you look at the stock market, for example, the stock market gives you a 9.5% every year for the last 90 years. So if you start with $1,000 instead of buying your PS5 console or your shoes, and you add $100 every month, at the end of the first year, you'll have $2,300. At the end of 10 years, you'll have $22,000. Now, I know a lot of people, especially at your age, you don't think about these things. And you're thinking, well, 10 years is a long time. I'm only 15 years old. Why do I have to think about what's going to happen in 10 years? Because in 10 years, you'll be able to buy the next big asset. You'll be able to buy that piece of land or that property or that house. You're going to need money saved up in order to do that, right? So let's come back to the initial slide. How do you make money while you sleep? And the answer to that question is passive investing. Someone else is managing the business. So if you invest in stocks, you are the investor. You invest in Apple stocks. Apple is a corporation that produces products that you use, iPads and iPhones. They make money and they pay you a return based on what you've invested. You're the investor. And whether you're awake or you're asleep, Apple is a worldwide company, right? They're global. Whether you're awake or you're asleep, Apple is selling products. Apple is making money. So in essence, Apple is still making money while you're sleeping. Compare that to active investing. If you're mowing lawns, you're only mowing lawns while you're awake, right? When you're asleep, nobody's doing that work for you. But when you're passively investing, and you're passively investing in good, solid businesses, good, solid corporations or properties, if you come to that age or that stage, then that passive investment is making money for you, whether you're awake or you're asleep. Stocks will do that. Property. So stocks, property are the two big main ideas of passive investing. So we're coming to the end of this. Any questions so far? Any comments? Okay. So what are your takeaways from this? Pay yourself first. The top 1% save 60% or more. Try to keep 10% aside from your allowance, from your job, wherever you're getting money from. Try to keep 10% aside for yourself first. Okay? Spend within your means. That means don't go and spend money that you don't have. Don't go and charge up on your credit card and pay over time, because that's what the environment you're surrounded by is. You need it now. Pay for it, charge it up now, and then pay over 20 months or 30 months. Beware of debt. Debt will kill you. It will really, really hurt you if it's not making money for you, in the sense that you're not using the debt to buy money-making property, or if you're not using the debt to buy rental property. Consumption debt will really, really weigh you down because of those interest rates are so high, right? 21%. Discipline yourself, right? You need to change your mindset. You need to get out of the mindset which basically says, I need this thing right now. Try to figure out a way where you can make money to try and go buy that thing later. The whole consumption economy is based on, I need this right now, whether I have the money or not. That requires discipline to not fall into that trap. And then invest in stocks. If you have, $50, $20 a month, invest in fractional shares of stocks. If you are getting older, you're in the workforce, then, you can start saving up money to buy some property. And compound, right? Reinvest your earnings. And the more you reinvest, especially when you get started at a young age, when you get started at, 13, 14, 15, with small fractional investments in stocks, you'll be surprised how quickly that starts growing by the time you're in your 20s, late 20s and 30s. And then SWAN. Anybody know what SWAN is? Anyone? Somebody wrote something. Swan is sleep well at night. So if you do all of these things, you will sleep well at night. So we've come to the end of our slideshow of our webinar, and I'm going to give you all some homework. Okay, so here's your homework. Figure out your budget. Even if you get an allowance, you have some money that's coming in, figure out a budget based on what you're bringing in. Carve out some money to invest. $5, $10, $15, $20 a month. It's easy to do, but you have to discipline yourself and start building your wealth. You know, everybody talks about, you know, the 1% own 31% of the wealth in the United States. And you know, what can I do? How do I become the 1%? Well, I'll tell you how. In order to become the 1%, you have to do what the other 99% won't. That requires discipline. So I hope you had a good time. I hope you learned something. If you have any questions, feel free to ask the questions. Otherwise, go to our website, albanyparkcapital.com. Hit the resources tab. I have a lot of articles. They're a little bit more detailed and more in depth regarding different types of investments, real estate. Talk about the stock market. We talk about a lot of other different things in regards to investment. It's all free. It's not, you know, you don't have to pay for anything. But if you have any questions, you can also go to our website and post a question there. I'll be happy to answer it. And if you have any questions here, I'll be happy to answer any questions.